Abu, thank you for having me. My name is obviously Vince Osbourne, and really happy to be here and to been invited to this forum. I'm currently the CFO of a mineral exploration company, so graphite in particular. I've been at this company since 2021, late 2021. And prior to that, I spent probably about 19 years in retail. So I was my last 12 years of that 19 was at Canada's second largest grocery chain. And I had a number of different roles within the corporate finance functions, handling budgeting, forecasting, capital planning, managing the valuations and impairment team, and supporting the real estate team. So it was pretty exciting times, great companies to work with, and then had the opportunity to make the shift over to my current company as the CFO and corporate secretary. Never did the corporate secretary role or the CFO, so this was a lot of good learnings for me and really being able to jump into that leadership type role and guide a small public company, managing their finance function and pretty much getting involved in everything. So it's been quite exciting. As far as my educational background, I am an accountant by training, so a CMA. I also have two business valuation designations. So, I kind of came across that by accident, I guess, in one of my roles. I was involved in a transaction. We were purchasing a small grocery chain and never did it before, and was part of the team and went through that and said, man, this is really interesting and really exciting. So as an accountant, you've got to do continuing education. And I figured, well, rather than, doing random courses, why not choose something in the valuation space and check it out and see how that goes. Well, what ended up happening is it turned into completing another designation and really enjoying and getting excited about these types of things and the type of work. So it really dovetailed nicely into a role that I got supporting the real estate team and then having to actually manage evaluations team. So that was really, really good and dovetailed into everything else that I've done after the fact. So I do, on top of my current role as CFO and corporate secretary, I do also do some business valuation consulting on my own. And I do some work with a boutique valuation company in Toronto. So they do valuations and forensic accounting. So it's been it's busy. I like to keep myself busy, but I love valuations and like being in the space. And really enjoy the topic overall. So I'm happy to be here to kind of take you through a brief presentation of valuation. We'll kind of go through and set the table on what it is, and then walk through some key principles, and then wrap it all together with an example of a random a company that puts some numbers together, and it kind of takes you through all of the concepts. And then at the end, we'll really kind of talk about, well, how do you unlock value? And part of that discussion, I think the first part is really understanding how it works and how it comes together. And then you really understand the levers around unlocking value in your own company, your own situation. So I'll share my screen. So please let me know if presentation is visible, Abu.
It was
Oh.
not anymore though. We saw the first slide. Then
Now?
okay, yeah,
Oh,
we can see
great.
it. Thank you. Yeah. Good.
So, so as I said, we'll kind of go through a very brief overview of what business valuation is, some of the approaches. We'll talk about discount rates very briefly, and then walk through a fairly comprehensive example of how it all kind of comes together. And then we'll talk about unlocking value. And, at the end, or throughout the presentation, if there are any questions, happy to address them at that point or at the end, whichever is easiest. So I'd kind of we went through this slide, a little bit about me and my background. I know Abu's interested in the martial arts piece. There's a connection with me getting the role, or the current people that I work with. One of my CEOs actually was my training partner. We did Krav Maga for probably about 7 or 8 years. And she said, "Hey, we've got an opportunity at another organization. Are you interested in joining?" And we'd had a good friendship through our training together in Krav Maga, and decided to make the switch because I knew I was working with a great professional, and it's a good relationship. So that's how that kind of dovetailed into what I'm doing today. As far as valuation is concerned, it's a set of processes and procedures to determine the equity value of a company. And equating it to what you see in the stock market, which a share of the price of a share of a stock is essentially that equity value. We're really doing this exercise for closely held companies. So private companies that do not trade on an active market. They may have 1, 2, 3, 10, 20 shareholders, but they're closely held, and there's no active market for it. As far as a process perspective, we typically value the full company. So we call that enterprise value. So there's two basic ways to fund a company. It's equity, you inject equity into the company, or it's debt. And the combination of the two are really the enterprise value. And I've included this, fundamental kind of formula down here. The equity value equals the enterprise value minus debt. And it also backs out what we call redundant assets. And redundant assets are essentially assets that may be in the business, but are not really part of the core operation. They don't really drive the generation of any cash flows. So you could have excess cash. Some people have art work that they may collect, or classic cars. I've seen, a gambit of different things. They don't really generate cash flows for the business. They are just assets that reside within the company, and are not really core to the operations. Abu, I think you had a question.
Yeah, a question there. So in terms of the enterprise value, is that both tangible and intangible assets?
Yes,
Okay,
it's
thank you.
tangible and intangible. And within the example, you sort of see how we break out what we believe that intangible value is. But it is really the whole thing, complete enterprise value. The concept of fair market value. So that's really, when we talk about price, we're doing this, the company has not been exposed to the market. It doesn't trade actively. So we're trying to, come up with the fair market value. And there are various standards of value, but fair market value is really the most common one that's used in these sorts of situations. And there's a formal definition of it, but essentially it's a hypothetical buyer and a hypothetical seller coming together. They are both willing and able. They have maybe equal amounts of information. They're knowledgeable. They're under no compulsion to act, and are willing to engage in a transaction. And fair market value is really the cash equivalent, or cash equivalents. We say that asset or liability would change hands. And it's really the cornerstone of overall business valuation theory. This graphic really kind of sums it up, right? So we have a hypothetical buyer, a hypothetical seller, and when they come together, that's really fair market value. This is the part that they're agreeing on. So effectively, this is the amount that they would transact. So valuation is in a notional sense trying to determine what that fair market value would be. There are a number of situations that drive the reason why we would do a valuation. A lot of times you may think of it, a potential sale, but there are a host of reasons why. Many of them fall under income taxation reasons, estate planning. You want to transfer wealth to a future generation, you may do an estate freeze or a rollover. Matrimonial law, that's a fairly large area. A couple is unfortunately going through a matrimonial issue. There may be a business involved through one of the partners, and they need to determine the value to split the assets. We also have things like purchase price allocation. So if another company acquires a company, part of the accounting rules require you to allocate the purchase price. So you'll determine tangible assets, intangible assets, and have those recorded in the acquirer's financial statements. You could be raising capital, M&A. Another interesting area is quantification of economic losses, so personal injury. There are a number of scenarios where you need to determine, you need to quantify the impact of someone's loss or a business's loss. Maybe there was a power outage, anything like that. So that analysis is used in that case. And fairness opinion. So in the case of M&A transactions, typically valuators will be tasked to do, or investment banks will be tasked to do a fairness opinion. So part of the board's fiduciary responsibility to determine, is this transaction fair from a financial perspective? So a host of different reasons and situations that require it. So the basic principles of valuation really kind of touch on three key things. And the value of a business is really based on cash flows, growth. So a company that's growing at a higher rate would generate higher value, and risk. And risk is part of when we get to the concept of talking about unlocking value. Risk is a key factor that a lot of entrepreneurs and business owners need to really think about, because it has a direct impact on value. You could put all these, financial statements and numbers and forecasts into a calculator and it spits out a value, but at the end of the day, you need to really assess the risks, because that's going to have a big impact on value. And as we talk about discount rates, that's where you'll kind of see the risk portion come to life. So there are a number of key principles in valuation. So, the overarching is cash flow, growth and risk. And there's a few key other principles that we need to sort of talk about and briefly go over. So when we do evaluation, we always determine a valuation date. So when we talk about a valuation date, it's really at a specific point in time. And depending on the venue and the reason why you're doing the valuation, it's done on the basis of, at a specific point in time, this is the information that was known or knowable. So in many cases, we can't look forward. But if we have a forecast that is forward-looking, it would have had to been done around the valuation date. So it's really at a very specific point in time. Value is also perspective. So it's really determining the value of a business on the future benefits, and those benefits being cash flows that are generated in the future. The market dictates the rate of return. So we'll get into that in a little bit more detail as we talk about discount rates and what that rate of return should be, because that effectively is what a discount rate is. And then as a general principle, and I believe you kind of brought this up with your question around tangibles and intangibles, but that net tangible asset value, the higher that is, generally the higher the value of the business, because we're always looking at it with different approaches, and that tangible net value is really kind of the baseline that we use. So the higher that number is, the higher the ultimate value will be if there's goodwill. So we did talk about, the present value of future benefits that drives value. That's a principle, but there is also, when we start talking about the overall value and determining that intangible value amount, there are two components of it. There could be commercial value, so that amount that's above the net tangible value, or there could be what we call non-commercial or personal goodwill. So if you're, for example, one person running a business, and if you were to leave, or maybe you've got multiple people there, but you leave, and the business can't operate without you, then there's a lot of personal goodwill. It's really attached to you running the business. You're driving the value. So that is also an issue as well, that needs to be addressed. Value is influenced by liquidity. So, small, closely held company, yeah, you may decide that you want to sell, or maybe you're a shareholder and you want to sell your shares, but there's really no active market for it. So it's highly illiquid. Whereas in the stock market, you go into your discount brokerage or whatever, hit a button, and you can buy and sell instantaneously. So liquidity does matter. And in many cases, if we're valuing a portion of the equity, we will provide for liquidity discounts. So you may have a minority interest. Let's say you own 49% of a company. It's $1 million. It's not going to be exactly 490,000. It may be less because there's a liquidity discount, and discounts for lack of control as well. And yeah, that kind of gets to my last point around minority interest. It may be actually less when you're looking at it on a piecemeal basis, or compared to a position that has control of the company. Because if you have control, you can influence key decisions and ultimately influence cash flows, which is one of those key principles. So we're going to get on, those are some key principles. We'll get into approaches and methods, and we'll the example will kind of look at one, but this gives you the overall arching view of how we approach valuation. So there's really the starting point of evaluation. You've really got to consider whether the company is considered a going concern. So it's an operating company, and we anticipate that it's going to operate indefinitely in the future, or whether it's what we call, liquidation value. So the company, maybe it's a holding company, or it's in distress and it needs to be completely liquidated. We'll look at it from that perspective. And for liquidation, the primary view is an asset-based approach, which we'll talk about briefly. For going concern, there's really three approaches. The income approach, where we look at cash flows, and we can look at a forecast of cash flows, or we can look at if it's a very stable company that's had consistent earnings over the last, say, 5 or 6 years or 10 years, then you use a point estimate to determine what that value is. The market approach, similar to when you're selling a house, you're determining what a selling price is. You're looking at comparables. So what are other houses within the neighborhood, similar size, similar property size, configuration, what are those features, and are they similar to yours? And you base a price on that. Do the same thing from a business perspective. And then the asset approach is really, as we do with the liquidation value, really kind of looking at, we're restating essentially the balance sheet to its fair market value for each line item. So you may have equipment or real estate on there. You would value that based on, historically it's booked at a historical cost in most cases. We would actually reset those values to market rates, and then you can determine what the fair market value of equity is. And that's the asset-based approach. So the income approach, this is primarily what we use quite often. Oh, Abu, you had a question.
Yeah, so can you use a combination of approaches?
Yes. So when we do evaluation, we effectively do all three. So we're looking at an income approach that may be a primary view. We want to rationalize the value that we're getting. So we'll also take a look at a market approach and look at comparables and precedent transactions. And then an asset approach is always done. So we'll always restate the balance sheet to determine what that tangible asset value is, because then we can determine what the intangibles are. So you're really kind of looking at three. That's kind of the most effective way to do it. And you're rationalizing the number that you're getting. So yeah, great question. So, the techniques that we use, some of them are forward-looking. So for example, the discounted cash flow method, that's based on forecasted cash flows. So mid-sized companies seem to be mid-sized and large, typically have a very robust or at least set forecasting and budgeting process. And they will do multi-year forecasts and budgets. So we'll leverage those as evaluator because we're operating from an independent basis. Our job is to really sort of step back and take a look at the reasonability of those forecasts because that's going to have a direct impact on value. So there may be cases where I say, the forecast isn't reasonable, and I'll make adjustments. But I'm really putting on my detective cap and really questioning and understanding, does this forecast to some degree mimic what's happened in the past, but is it reasonable for the next 5 or 10 years that are being forecasted out? For capitalization of earnings and cash flows, it's really based on normalized. So we'll look at the last 3 or 5 years and adjust financial statements to say, well, what we call normalized. So are there one-time events in there, things that are not at market value? So an example of that could be salaries, right? And closely held companies, people could be paying themselves too much or too little. So we'll adjust those back to market rates. And that's what we would call a normalized earnings or a normalized EBITDA. So yeah, and as I said, DCF approach is really kind of forward looking, but it really has an impact on how well you can forecast. And typically smaller companies may not have a forecast, they may not budget, but again, when we get to the conversation of unlocking value, I think it's an important consideration, an important thing to do to really kind of plan ahead. The market approach. So as I said, very similar to like what you'd see from a real estate perspective. What we're doing, and there are two sort of analyses that we do. One is comparable company analysis. So we'll look at data on particularly stock market data on similar size and similar types of companies that are publicly traded. And where it gets a little bit tricky is it sounds easy that there may be similar companies out there, but that's not always the case. One of the last, valuation files that I did, there were very few, if any. I couldn't find any that were the same. One that was somewhat similar on a publicly traded market. So then it's a little bit tough, but you've got to make some adjustments and make some professional judgment in that case. Stan, I think you had a question. You raised hand.
Yes, I do. Vince, first off, thanks for making the time and sharing some perspective here. Really appreciate it.
Oh, thank you.
So market approach, basically, if I had to boil it down, what you're saying is that's just fundamentally a benchmark, right?
Yeah.
I am grossly allergic to benchmarks for so many different reasons. And what I'm sort of struggling with is if someone is taking this market approach, aka benchmark driven approach, it's extremely difficult to truly find an apples to apples comparison between two organizations because of so many factors and processes in terms of execution, all these little things that you just can't really take an apples to apples snapshot, except for if that other company fully opens up what they're doing, you try to normalize one to the other.
Right.
So is this approach a favorite approach, or is this the least favorite approach by those running the evaluations?
I would say it's a favorite approach because you're really relying on market data. So information that is out there and available. What you're saying around the challenges of finding similar companies is a fact. And that's what makes it quite difficult, actually. So it may be in some cases a primary approach that's used. So I'm going to primarily do a market approach, but I'm also doing the income and asset to really kind of triangulate the valuation. Does the result make sense? But that's part of the art of valuation, I'd say, in the sense where that that comparable pool of companies that you have, you may need to make some adjustments. You may need to consider, well, this is somewhat similar, or there's some instances where, yeah, it's probably a good comparative, but others where it's just not. So it's really up to the evaluator to kind of document the reasons why they would include or exclude a company from that peer group. But it's not perfect. That's just generally the challenge, but
Got it.
it's really is a preferred approach because the data is there. These are at market transactions that are happening, particularly if it's a very liquid market, right? So people are third parties are trading based on what they believe these companies are worth. So that's the benefit of market data. The challenge is if you have a company that really is not similar, or you can find a decent population, that's where it's tougher.
Got it. And then just to confirm this point, intangibles like culture and people, things like that, that's totally excluded from the equation, right? This is purely about money on the books and physical assets on hand, more or less, in terms of running the evaluation.
So the valuation does pick up all of those items that you mentioned.
Okay.
When we're looking at enterprise and when we're effectively looking at equity, it picks up all of those items. There are other tools around determining what. So if you have an intangible value of X, well, what's related to brand? What's related to workforce? Or any of those other items? We have other tools in our toolbox to determine what they are. The starting point is, can you identify what those are? So a brand is, you can identify that's an intangible asset. The nuance is can you determine what impact that brand has on cash flows? So what cash flows does that brand actually generate? So I'll give you an example. So if you were to value Coca-Cola, and at the same time value, they have producers of off-label or no-name type beverages. Well, the difference is in the margin between what Coke can sell at versus what a no-name or an off-label brand could sell at. That effectively, you could say, well, that's really kind of the brand, right? You've got a well-known worldwide brand that can drive incremental margins. So that impact, that influence, that delta in cash flow, you could really attribute to brand. So it's really understanding what cash flows those intangibles drive. Some of them you may not be able to identify what they are. So they kind of get lumped into what we call goodwill. So one of my first slides when I talked about purchase price allocations, that's where we get into, okay, the business was purchased for X. We can determine what brand that intangible is worth. We'll do things like there could be other intangibles like workforce or any other sort of soft type intangible asset that's there. You can differentiate those.
Got it. Thank you.
You're welcome. So just to finish off the comparable company analysis. So once you've determined what that group is, we look at a number of multiples, valuation type multiples. So you've probably heard of, price to earnings or EV to EBITDA and price to sales. We'll get those lists of companies, determine what those multiples are, and then really kind of use it as the benchmark to say, well, if I have these similar group or this peer group that's trading at 4 times EV to EBITDA, I could apply that to the earnings of my company and determine what that range is, and that would be an estimate of the value. But again, you likely wouldn't do this on a standalone basis. What we also do is what we call precedent transactions. So these are sales of private companies. Obviously, they haven't happened on the stock market, but a lot of brokers or investment banks will provide data to certain specific databases, like what I have at the bottom, like Deal Stats, FactSet, S&P, Capital IQ. They'll collect information on private sales that have occurred, and there'll be a number of different data points, similar multiples that you can derive from there. And again, you're using that as a population to assess, well, is EV to EBITDA, 4 times, or price to sales 2 times, and you can apply those multiples. As far as the asset approach, we won't spend a lot of time here, but as we sort of talked about, it's really taking the balance sheet and reclassing it back to fair market value. So typically, accounts receivable, that will typically be at fair market value. You'll assess what may be collectible or not collectible as you get to like equipment or real estate. So with real estate as an example, with a valuation report, we'll ask a third party to do an actual appraisal. So get a real estate appraisal done, and we'll adjust that to fair market value. So you're really going through the balance sheet and determining what that base asset or adjusted net book value is. So discount rates. And this is really the cost of capital. So when we talk about discount rates, you'll probably hear 2 terms out there. There's a discount rate, and we'll talk a little bit about what that is. And there are capitalization rates. And the difference between the two are really around discount rates are applied to discrete cash flow. So if we're doing a 5-year forecast, we'll discount each year's cash flow by the discount rate. So it factors in that the cash flows will change over time. There is growth embedded in there. So when you see, this section here, it's applied to a series of cash flows, but there's no growth factor applied. The discount rate is higher than a cap rate, which pulls out a growth factor. So a cap rate is applied to a 1-point estimate of a cash flow to determine what that value is. So, and there's the basic formula. So the discount rate minus the long-term growth rate equals the capitalization rate. And that growth rate is a long-term growth rate. What they both reflect is a rate of return. So what sort of rate of return is an investor going to require to invest or purchase this company? We'll get into it. So here's, so when we look, traditionally when we do this, we look at, or we use what's called the weighted average cost of capital. And effectively, it's a weighting of both equity and debt, because those are the 2 sources of capital of a company. And that weighting will really be based on what we see in the market. So I've put together an example here, and this is from, an actual file that was done, where we use a build-up approach. And there are multiple ways of doing this. There are the capital asset pricing model can be used to determine the cost of equity. But this is by far a very clear, kind of simple way that we build it up without getting into the math of a capital asset pricing model and betas and all that good stuff. So what we do is as it says, it's a build-up approach, and the key components of it are, a long-term bond rate or yield. This is really what we call the risk-free rate. So we're going for a US or Canadian 20 or 30-year yielding bond. So we're saying that's as risk-free as it kind of gets. The equity risk premium, this is really the premium for an investor to invest in stocks rather than into fixed income. So fixed income is deemed to, typically has a coupon rate, lower risk. The capital is always preserved where the principal is. For someone to invest in something that's riskier, stock market, there would be a required premium for that. So we determined that to be 8.18%. There's a size premium. So a lot of the studies that we use to support this are historic studies that have been done using regression analysis in particular for size, larger companies versus smaller companies and their rates of return on the stock market. So typically, smaller companies have had or expected to have a larger return as opposed to larger firms. So depending on the size of the firm, whether it's based on earnings or sales, we will determine what that size premium is, and that's from studies from S&P or other type markets that track this information. There will also be industry risk premiums. So depending on the type of industry, there may be other required rates of return. So an industry like mining may be more deemed to be riskier than, let's say, manufacturing or textiles or any other industry. So there are risk premiums that are added into that as well. And then we have another one called company risk premium, and this is really specific to the company that we're valuing. And I'll get into the next slide, kind of talks about some of the items that we look at there, but this is where there's you'll see a lot of professional judgment, and you're really stepping back and assessing, the company that's being valued in this particular case. Are there certain factors that we're saying is not captured in size, not captured in an industry, but is very specific to this firm, and we'll typically put a premium in there, and that can range from 2% to 10%. That's generally what I kind of see as the range. So you determine your cost of equity and the weighting of equity. So we're saying this company is capitalized 75% on equity and 25% on debt. Because all of these equity premiums are all on an after-tax basis, when we're looking at the cost of debt, we also have to back out taxes as well. So we've determined cost of long-term debt is 9.2%. And typically what we'll do is we'll look at prime plus 2. So we're always looking at what is generally in the market, and then back out the tax rate. In this case, our corporate tax rate in Canada is 26.5%. So we'll determine what that after-tax cost of debt is. And once you apply the weightings in the after-tax, your WACC, or your weighted average cost of capital, is 26.39%. And to get a cap rate, so if we were to do this on one specific cash flow to determine what the value is, we assumed our long-term growth rate of 1.8%. So our cap rate's 24.59. So this is the complete buildup. In a lot of valuation reports, you will see this. In some cases, you won't, because some of it is like the company's specific risk premium is quite subjective. So sometimes valuators will not get into those details. You may see a multiple, and a multiple is easy to calculate. It's really a reciprocal. So 1 over the discount rate gives you a multiple, so 4x or 5x. But when you see a multiple, the important thing to note is there's always an implied discount rate behind it. So it's important when you see, if someone's saying, well, I can get 4x, 4 times, EBITDA for my company. Well, always work back. What's that discount rate? 4 times, so we'll get 25%. Does that seem reasonable? And you could really kind of backward, I guess, or re-engineer it, or kind of unpeel the onion to kind of determine, well, where are these values coming from? But it's really good to think of it in terms of back to a discount rate. So this really kind of gives you a very granular view of how that buildup occurs. Premiums. So we talked about industry size, the company specific premium. I'll kind of get to what really potentially drives those. So one thing is customer concentration. So when we're doing evaluation, a lot of times, and we're asking a ton of questions, there's quite a bit of due diligence that has to happen. But one of those key risk factors that would drive a higher risk premium is customer concentration. If you've got, 20 customers and 2 of them account for 60% of your revenue, well, that is high risk. Those 2 customers, something happens to them, they decide to go somewhere else. That's a very significant impact on your business. So that will drive a higher cost company specific risk premium. Forecast risk, I've come across forecasts that are very, very optimistic. And I will adjust them. Or if I do think they're risky, that can impact the company specific risk premium. Key employee dependence. So we kind of talked about this. If you have one person that really understands and runs everything, and that transfer of knowledge hasn't happened, if that person leaves or something happens to them, that could be a significant risk to the company. We'll look at management team experience, history of earnings. So companies that are relatively new, they haven't had that track record. So you have to factor in a risk premium for that, because until you get some history and see that they have had multiple years of positive earnings, it's a risk. And then other things like employee turnover. Some companies are higher in that sense, and that's a risk. And the overall cost structure. So companies with lots of fixed costs, not a lot of flexibility when the economy may put some pressure on the company itself. Stan, you have a question?
Yeah, sorry, before you go to Stan, just be mindful of time. I think we have about 10 minutes.
Okay,
yeah.
all right. I'll
Go ahead, Stan.
move quickly.
Yep. So real quick, do you account for risk in the sense of obsolescence? So you've got a company that's been running in an old school fashion for a long time. Are you guys looking at that as well, in terms of whether or not that company can pivot and or be successful in today's digital environment?
Yeah, we will consider that. So a lot of what we're doing is having conversations with management, really kind of understanding the industry, the landscape. How has the company adapted to change in the past? And are they really kind of open to being flexible and adapting going forward as the landscape changes, right? So that again is really more professional judgment in assessing. There is flexibility here or no, and that really kind of comes out in do they have processes documented? Do they really support talent development and knowledge transfer? Those things come out maybe in other areas or other questions that you ask, but it would be something that we'd assess as well.
Awesome.
That
Thank
answer
you.
your question, Stan?
Yes, it does. I mean, I've got a bunch more questions, but I'm just being disciplined here. So thank you.
So in the interest of time, I'll move really quickly through this example. So I've put an example here together. Manufacturing company, number of years of fairly stable pre-tax income, right? There hasn't been major swings. It's moving in the right direction. This section here is what we're getting to an EBITDA number. So it's earnings before interest, taxes, depreciation, and amortization. So the depreciation comes out, we add that back. The interest adds back. And then some of the normalizing adjustments that we do that I talked about earlier, related party remuneration. So this is, not salaries that just aren't at market, or, you have a cousin working there that doesn't really do anything, but, is getting paid, a pretty decent salary. We'll adjust for those types of items. Loss and gain on sale of fixed assets. Those again are one-time items. You're not selling this stuff every day. This is like selling fixtures and equipment. Acquisition related costs, again, it's a one-time, you're not doing this every day. And things like environmental cleanup in this case. So we back those things out and we get to a normalized EBITDA. And then we'll use some professional judgment on picking a low and a high. So we always want to provide a range and then a midpoint on what the value is. So in this case, we said, let's pick the low, 2023 and 2024, 5.2 million, and a high of 5.8, because they've got a budget here. So the average of those. We're going to use the capitalized cash flow because, again, they've been in business for a while, fairly stable. We think it's going to, not going to be any peaks and valleys here. It'll grow at a fairly consistent rate. So everything that we're doing is on an after-tax basis. So we're backing out taxes. So here's our low and high that we normalized EBITDA. Sustaining CapEx, so it's a manufacturer. You got to continually invest in the company. Equipment will break down. There has to be some sort of CapEx to maintain these earnings and to grow these earnings. Because CapEx is tax deductible, we determine what the tax shield is on it. So that's a net benefit to the company. It will reduce cash outflow. And then we also look at incremental working capital. So, as your company grows, depending on your cash conversion cycle, you may need more or less working capital. So we do take a look at that and factor that in. So we get to what we call a normalized discretionary cash flow. So these are after taxes, after accounting for CapEx and any other incremental working capital. We put in a cap rate because we're looking at it at one point in time, and then divide by that, and you get your capitalized cash flow. Because the business had assets in it already that are going to have a tax shield that you're going to have tax savings on, we factor that in as well, and we come up with the enterprise value. So this is the total company, the total value of the company at an enterprise level. Once we get that enterprise level, we want to determine what that equity value is. So if you remember that formula, we're taking the enterprise value, we're backing out the debt. In this case, we determined that the company did have excess cash. So we will do analysis to determine, well, is all the cash that you have on hand, many times companies will either have a deficit and require additional lendings to have the appropriate amount of cash, or they may have excess. On the balance sheet, they may have other redundant assets, so loans that have been made to related parties that really have nothing to do with the core operation, one-time adjustments that will factor in, and then the taxes around that. And then you get to what we call an on-block equity value. So that just means all equity. We're not valuing a portion of the equity. When we round these values, this is the asset approach. So we did, as I said on the balance sheet, we restated everything to fair market value to determine what's that net book value, the tangible net worth. So that 8.6 is here. So that would determine that of this value, the residual is an intangible value of 15.1. And that could include brand, workforce, software, you name it. Anything that falls into an intangible umbrella is probably there. And this, as we kind of look at this, and it's probably another discussion around, the risk level associated with having a fairly high intangible value. It's not something that you may be able to tangibly to be able to sell. Things like customer lists or anything like that would have value. You could probably sell those, but other things you may not. So that would impact the risk profile. Super quick on unlocking value. And we touched upon a lot of these during the slides that we talked about today, but really documenting processes and procedures, understanding your key KPIs, like how does your business make money? How can you generate incremental margin? Capital allocation. A lot of what I did at my previous employers from this valuation space was, well, if you want to purchase an asset for your business, are you looking at what sort of return that you're going to generate? If your cost of capital is 20%, and this asset that you're going to purchase is going to generate, a return of 15%, well, then you're offside, right? You're not hitting that hurdle rate. You're not covering your cost of capital. So that's why it's just not about valuing a business. You can apply this to every investment decision-making process you have in your company. Having the right amount of insurance, shareholder agreements, super important if you've got multiple shareholders. If someone wants to leave, how do you determine the value? A lot of that's set out in shareholder agreements on we will use this approach, or we will determine what the value is using a formula. All those types of things are addressed. I know we're shorter in time, so I'll kind of leave it there. I can be reached for any questions. I'm happy to address them at any time. Please reach out.
Thank you so much, Vince.
Sorry, we ran short of time here.
Wow. Let me just open it up for the next maybe about four minutes to the folks on the call. Do you have any questions? Do you have any comments? This has been for me. I'm not a financial person. I mean, I understood what I could.
There's a lot. There's a lot.
Yeah, there's a lot there to unpack. I understand. I understood the flow. However, open it up for questions. I think we have a hand up.
Yeah, Stan.
Is what asked me, but I want to give an opportunity for anyone else to ask a question first. So
Thank you. We have Elaine, Che, Chukuka, Cornelius, and
How's it going, brothers?
how are you?
How you doing?
Doing well. Appreciate the presentation, Vince, and appreciate you guys putting it on. So I was just curious because I've been studying business acquisitions for probably a year now. I was trying to make my first purchase last year, but had some family issues. I was curious in regards to what are maybe the top 3 categories you see in the business acquisition space that may be worth the closer look at, you know? So I'm thinking about like stable profits, legacy businesses like funeral homes, you know, real estate property management companies that are more so stable in terms of the cash flows every single month, right? So those go at a higher cap rate because of that. I wanted to see if you thought the same or get a different perspective in terms of how you know, what you're focusing on in terms of what you see as most attractive in terms of business acquisitions, or maybe if you didn't have a preference at all. So just wanted to throw that out there.
Yeah, no, that's a great question. I think, you know, I'm industry, I would say probably industry agnostic, right? I think within any industry, you can find something that's quite interesting. I find that, you know, the companies that probably generate a lot of stable cash flows are the boring stuff, right? But you're really looking at the quality of earnings and really, you know, put a lens on, you know, if I were to take this over and acquire it, what's the quality of those earnings? Like, is it all going to fall on me, or do I have the appropriate staff to keep the business running? The most valuable companies are, you know, when the owner can say, well, you know, I've been playing golf in Florida for 6 months and this thing just runs on its own. That's when you know you've got something that's of high quality that can be stable and is not dependent on one person. But as far as industry, I think you can find a gem pretty much anywhere. I don't have any real favorites, but I think it's really about assessing the quality of the earnings that you're getting in those companies.
Okay, thank you. Thank you for that. I apologize, but we are at time. It sounds like we need another session though.
I'd be happy for one just to answer questions. That would be great. Thank you.
Thank you so much. Again, this has been eye-opening. As a non-finance person, this is incredible. I'm sure the finance folks, the investment folks are salivating. I guess they are. Thank you so much for your time. I know that it's a busy period for you. Really appreciate you coming on today.
Well, thank you very much, Abu. It was great to be able to meet the folks and present this. I know it's a lot of information, but like I said, reach out at any time. I'm happy to address any questions and provide any help that I can.
Thank you so much again. Good evening.
Yeah, thank you. Have a great night, everyone.
Take care.
Take care.